Welcome to lecture 20 of corporate finance, and in this video we are continuing our discussion on the dividend policy and dividend theory. So the learning goal or the contents of this lecture are the theories of dividend policy. So in previous lecture we explored what dividend policy is and what are different types of dividends. And then we said that should the firm pay higher dividend or lower dividend, or should the firm even pay the dividend or not. So we are going to explore the reasons why a firm should pay higher dividend or why a firm should pay lower dividends, or what are the factors that would affect the dividend policy of a firm. And so there are mainly 5 theories that explains why some firm pays higher dividend or why some firm pays a lower dividend. So we are going to explore these 5 theories in this lecture. So the theories are, the first one would be the dividend irrelevance theory. Then we would have bird in hand theory, or dividends preference, or dividend is preferred theory. Then we have text effect theory, the information content, or normally known as signaling theory, and clientele theory. Starting with the dividend irrelevance theory. So if you remember the capital structure lecture, there was a capital structure irrelevance theory, right? And that theory said that capital structure is irrelevant. That theory was proposed by Miller and Modigliani, 1958. Similar to that theory, Miller and Modigliani proposed a theory regarding a dividend policy, and that theory was proposed in 1962 in their paper titled Investment Policy Matters. So if you have gone through the capital structure theory, the lecture of capital structure, the irrelevance theory in capital structure, you would immediately get an idea that what this theory would propose. This theory proposes that dividend is irrelevant. In simple words, that whether the firm increases dividend or decreases dividend, it would not have any effect on shareholder wealth or the firm's value. So this is the crux of this theory. But we need to prove mathematically or logically how this theory would hold, or what was the argument of Miller and Modigliani that they presented in this paper. So what this is saying is that dividend policy is a time pattern of dividend payout. So if a firm pays a lower dividend today, so what they essentially are doing is that they are saving the dividend, they are retaining the dividend, or they are retaining the part of income that is not paid in dividend, and that retained earning would be used to expand the business. And if the firm expands the business, the future dividend would be higher, right? So what this means is that the dividend policy or the dividend payout is just the time pattern. So whether the firm pays lower dividend today and higher dividend later on, or it pays higher dividend today and and lower dividend later on in the future. So according to this time pattern would not affect the firm value. And to illustrate this argument of we need to take help of this example. So assume there is a firm, ABC Corporation, and this firm plans to dissolve itself, right? This firm would liquidate itself. It would sell off the assets within 2 years, right? All the assets, and this firm, this business would cease to exist. The total cash flow the firm will generate, including the proceed from the liquidation, that is from the selling of the asset, will be 10,000 each year. So if I simplify this para, it is simply stating is that this ABC firm would sell itself, this firm would sell its assets, all its assets within 2 years, and each year it would get $10,000, which it would distribute in its shareholders. And what we need to do is we need to estimate the present value of this share if we have two scenarios. Let's call this current dividend policy, right? According to current dividend policy, equal dividend will be paid in each year. So if there are 10,000, there would be a 10,000 cash flow, and this needs to be distributed among 100 shares. So each share would get a dividend of 100 in the first year, right, and 100 in second year. So this is the current policy, or the first scenario. The second scenario, or the proposed policy or alternate policy, is that in the first year the firm pays 11,000 dividend, and in the second year it would pay lesser dividend. How much I would just explain in a moment, but these are two policies. So why do we need to make these policy, and what we are going to do is we are going to see whether the firm value changes if we alter the policy. So what would be the firm value in case of current policy, and what would be the firm value in case of alternative policy? So if the firm value is same, if we can mathematically demonstrate that the firm value is same in both these policies, whether the firm pay a 10,000 dividend this year or 11,000 dividend in the first year, which is alternate policy. So if the firm value doesn't change, then we can conclude that the theory is correct and the dividend is irrelevant. So let's demonstrate this. So we have a current policy, and according to current policy, 10,000 would be distributed in first year and 10,000 would be distributed in second year. If that happens, then that means there are 100 shareholders. So if we divide that, so each shareholder would get 100 rupees in first year and 100 rupees in second year. And if we discount to find the present value, assuming that there is a 10% discount rate, if we discount this, so this would be plus 0.10 raised to power 2. The answer we would get is 173.55. So this would be the present value of this share. Remember, dividend growth model argued that the intrinsic value of a share depends on its future dividends, the present value of its future dividends. So its intrinsic value would be the present value of all its future dividends. So according to current policy, the value of the share should be 173.5. So according to alternate policy, what would happen is in the first year the firm would pay 11,000 rupees in dividend. But if you remember, if the firm liquidates its asset, it would just get 10,000 in first year. So how it can pay 1,000 extra? How can the firm pay 11,000 whereas its cash flow would be 10,000? What the firm would do is it would borrow 1000 rupees and for 1 year, right, it would have to repay this 1000 rupees in next year at 10% interest rate. So now the firm have solved the cash flow problem and do have 11,000 rupees in this first year. And if the firm pay 11,000 rupees in its 100 shares, then each share would get 110 rupees. But in second year, the firm would get 10,000 from the liquidation of the asset, that is from the selling of the asset, minus it would have to pay 1,000 this borrowed amount back to the creditor, and it would also have to pay an interest of 10% on this amount. So the firm would be left with 8,900, and if this is divided in this 100 shares, then each share would get 89. So now if we discount this again at 10%, the present value would be equal to 173.55. So in both the policies, the current policy and the alternate policy, the present value of the share remains the same. Hence, it doesn't matter which dividend policy do you choose, the value of the firm or the value of the firm to the shareholder or the present value of the dividends or the intrinsic value of the share would not change. Now this was so the conclusion is that the value of the stock is not affected by change or switch in the dividend policy. So we saw that under the current policy and the alternate policy, the dividend under the current and the alternate dividend policy, the value of the share, the value of the firm remained the same. So an increase in dividend at some point in time is exactly offset by a decrease somewhere else. So it simply means is that if the firm paid higher dividend in the first year, it would have to pay lesser dividend in the second year. So the conclusion is that dividend policy doesn't matter. And there is one more argument to support this theory, and that is the argument of homemade dividend policy. What homemade dividend policy means is that the shareholder can alter the dividend policy according to their needs, irrespective of whether the firm is paying higher dividend or lower dividend. So irrespective of the dividend policy of the firm, the individual investor can alter the dividend policy by themselves, and that's what we call homemade dividend policy. So what it says is that the investors have the ability to change the firm's dividend policy to suit themselves. So the tailored dividend policy created by individual investor who undo corporate policy by reinvesting dividend or selling the share of the stock. What this simply means is that if the investor wanted to receive 110 rupees of dividend in first year, if this is what this investor wanted, but the firm chose to pay 100 rupees in first year. So this is the corporate dividend policy, the firm's policy. So if the firm is paying 100 rupees of dividend, but the investor wants to have 110 rupees cash flow, then what the investor can do is it can borrow 10 rupees from a bank at 10% interest. So what would happen is, although the firm would pay 100 rupees under the current policy, but the investor would get additional 10 rupees from the borrowed amount from the bank, and hence its total cash flow would be 110 rupees. What would happen in second year is that the company would pay 100 rupees, but the investor would have to return this principal amount, and at the same time a 10% interest amount. So the investor would get 89 rupees of dividend, which is exactly same as the uh, the second policy, right? So in second policy, in alternate policy, the investor got 110 in first year and 89 in second year. So what this illustration means is that the homemade uh, dividend policy argument says is that it doesn't matter what policy the corporation is suggesting or making, whatever decision dividend payout decision the firm is making, it doesn't matter, it would not affect investors. Why is that so? Because if firm is suggesting a current policy, then the investor can alter that policy in their own interest and can have a different cash flows, or they can have the alternative policy that they want, right? Okay, so this is what this statement says, is that the investors have the ability to alter the firm's dividend policy to suit themselves. So, so the dividend is irrelevant according to this theory. We move towards the second theory, which is bird in hand theory, or it is also called desire of current income or dividend preference theory. Now, why it is called dividend preference theory? Because according to this theory, the investors prefer dividend. Why do they prefer dividend? There is a saying that a bird in hand is worth two in the bushes. So what it means is that uh, a dollar in hand, a dividend in hand is better, a lower dividend in hand is better than a higher dividend in future. So in simple words, people prefer to have cash in hand. People prefer to get uh, the dividend uh, earlier as compared to dividend in future. And this theory was presented by Gordon and Linter in 1963. So stocks, and the reason is that if a firm pays dividend, so let's say I purchased a stock at 100 rupees, one share at 100 rupees, and if that firm paid a dividend of 10 rupees in first year, so so it means that I have already recovered 10 rupees and now I am left with 90 rupees to recover, so that my cost is recovered, right? So if a firm pays dividend, that reduces the risk of the share, right? Compare this with another firm. The share is also at 100 rupees. This is firm A and this is firm B. This firm do not pay any dividend, right? So the dividend is zero. So now to be at break even, I need to the price need to remain at 100 rupees. So the dividend paid would reduce the risk of the shareholder. So according to this theory, according to bird in hand theory, people desire to have current income as compared to the future income. They prefer current income, and that's why people would prefer higher dividend. And it says that the firm paying higher dividend would have higher value or higher prices. This is what this theory is saying. So the higher the dividend, the higher would be price. Dividends are good and they should be paid. This tax effect theory says that lower dividends are good, that the firm should pay lower dividend because of taxes. Why is that so? So According to Pakistani law, if you are a filer, then you would have to pay 15% tax on dividend, and if you are non-filer, then you would have to pay 30% tax on dividend, and this tax would be paid immediately, right, at the time of receiving the dividend. But what about capital gain? By capital gain, we mean the change in the price or the increase in price, the earning due to increase in price. So if you bought a share at 100 rupees and the share price increases to 120 rupees, so this 20 rupees increase in share price is not your dividend, it's capital gain, the amount you have earned due to increase in price. But now, so the taxes on dividend is paid immediately as soon as you receive the dividend. These taxes are deducted at source, and you would receive the net amount in your bank account. But in case of capital gain, so let's say you bought a stock in January, on 1st of January, and on 5th of January its price increased and you have earned a 20% capital gain. Now, when would you pay tax on this capital gain? You would have to pay taxes on this capital gain at the end of year, not immediately, right? So you have higher liquidity, you have higher amount to reinvest, and besides, if you hold this stock and you do not sell it, then you wouldn't have to pay this capital gain. So this theory is saying that because of this tax cost or this higher tax on dividend, or that dividend taxes are paid immediately whereas capital gain taxes are paid later in time, therefore lower dividend should be preferred, because if a firm pays lower dividend, then its prices would increase, because there is a chance that the firm would reinvest the retained earning and its business would grow. So let me conclude this. The reason for paying low dividend is explained by the tax theory, and it says that firms should pay low dividend because dividend income are taxed higher, their tax rate is higher than capital gain tax rate, and the capital gain tax can be deferred until the stock is sold, but the dividend tax cannot be deferred. So due to these reasons, dividend should be lower. Whereas the higher dividend proponents suggest that if there are two similar firms, the one paying larger dividend would always sell at a higher price, because people prefer to have current income, people prefer dividends, and because the higher present value of current dividend as compared to future dividend. So this 100 being paid today and this 50 rupees or 100 rupees being paid after 1 year, obviously this would have a higher present value as compared to this one. So higher present value of current dividend as compared to future dividend, so people would prefer a higher current dividend as compared to a higher future dividend. And because there are certain investors who are exempted from taxes and they would demand a higher taxes, or there are certain okay, so the other reasons would be discussed in other theories. So the conclusion is, based on homemade argument, dividend policy is irrelevant. It doesn't matter which dividend policy do the company follow. According to tax effect theory, the individual investors prefer lower dividend, or lower dividend is beneficial for the investor. According to the bird in hand theory or desire for the current income theory, high dividend policy is should be preferred. So the other So we would, in next video we would explain the other two theories. So that's all for this lecture.